Greetings. My name is Dave Yeske, and I am a co-founder and managing director of Yeske Buie. I'd like to spend the next approximately half an hour talking to you about our investment philosophy and how it guides us when we are developing and managing diversified portfolios. I'm going to organize my comments today around the core principles that guide us when we're thinking about how to design and manage a diversified global portfolio. First, our ability to predict the future is extremely limited. Markets do a good job of relating risk to return. There are different kinds of risks that must be accounted for when developing and managing a portfolio over time. Portfolio structure explains performance, and by this I mean the particular types of assets you choose to include and in the proportions in which you choose to include them will have a bigger impact on your ultimate experience than almost any other decision you make. Finally, diversification matters. Diversification across many different dimensions, all of which I'll talk about. A few years ago, I was skimming through an issue of Discover magazine and came across an article devoted to the subject of weather prediction, and most specifically the question of why is it so difficult to predict the weather. And in this article, I saw the image on the right. This is a radar map of a major storm system that went through the Midwest in 1999, spawning 7 tornadoes and doing over $1 billion worth of damage. Looking at this image, I was suddenly reminded of the image on the left, which comes from smartmoney.com's map of the market. And it's an attempt to use color variations to illustrate at any given point what's going on in the market, with bright green indicating stocks or industrial sectors that are doing well, with red or bright red indicating sectors that are doing poorly. And as I spent more time thinking about it, I realized that in fact, one of the reasons that markets are so difficult to predict, and for that matter, economies as a whole, is very similar to, or in fact identical to, the reason that weather is hard to predict. The reason we cannot predict the weather with any accuracy in the short run is that it is such a complex and chaotic system that unless you could map the position and velocity of every single molecule in the land and the sea and the air in real time, you can't possibly know how the system is going to evolve. And in fact, one of the fathers of chaos theory or complexity theory, Edward Lorenz, was in fact trying to model weather systems back in the 60s when he came across these findings. He found that if he made even tiny changes to the initial conditions when he began a weather simulation, it would cause the system to go off in radically different and unpredictable directions. And this is true in the economy, and it's true in the markets. Small and difficult to observe changes in initial conditions can cause this complex and chaotic system to go off into unpredictable directions. Now, that doesn't mean there's nothing we can rely on. While short-term prediction is problematic in the markets, just as it is with the weather, it doesn't mean that there aren't deeper regularities that emerge. This image on the lower right, by the way, is known as a Lorenz attractor, named after that same Edward Lorenz I mentioned. And what it shows is that chaotic systems will tend to converge on common points over time, even though the path they follow may vary wildly. We see the same thing in the economy and in the markets. There are deep regularities that we can begin to rely on. Among those are the ebb and flow of the business cycle. The economy will inevitably wax and wane, advance and decline, and this has implications for how we build a portfolio and how we weather those periods of decline. Another regularity is that stock returns, equity returns if you will, over longer periods of time are higher than the returns to risk-free assets like CDs and passbook savings accounts. Finally, value stocks produce higher returns than growth stocks, and small company stocks higher returns than the rest of the market, than large company stocks. And that's because there are unique risks here that the markets are accounting for. So if we can identify these longer-term regularities, we can begin to think about harnessing them when building a diversified portfolio. So let's now talk about some of the sources of those regularities that I just noted. Some of them arise from the very nature of the market and how the market works. Over the last 60 years or so, there's a large body of research that's emerged under the general heading of modern portfolio theory. And out of all of the hundreds of thousands of research initiatives and millions of pages that have been printed on the topic, there's a very real sense in which you can distill it all down to a simple two-dimensional graph that looks like this, which relates expected return and risk. And the upward slope of this line is telling us that there is a systematic relationship between risk and return. That if an asset is riskier, it's going to be priced for a higher return. Or as an investor, if you seek a higher return, you're likely going to have to accept more risk in order to get it. Now, some have said that the old verities no longer hold, that globalization or financial innovation or high-frequency trading have changed everything, and we can no longer count on this systematic relationship between risk and return. And to that I say, nonsense. The upward slope of this line is not the product, nor can it be damaged by financial innovation, high-frequency trading, or any of these other things. The positive slope of this line is a manifestation of millions of years of evolution. It's a manifestation of human beings' natural aversion to risk. On average, humans will not take risk unless they're given a proper inducement to do so. And that perhaps will change in another few million years, but for the time being, I think we can count on this as being an enduring feature of the markets because it's an enduring feature of human beings. Now let's look at the historical record. This is a wealth index in which I've taken a $1 investment in various assets and grown it over the years, from 1926 to the present. And what you can see right away is that there are two thin lines on the bottom that spend most of that time sitting right on top of each other. One of those represents the inflation-adjusted value of $1, and the other represents a 3-year Treasury bill, which is a good proxy for other safe investments like passbook savings accounts and short-term CDs. So what you can see over that long span of time is that an investment in a 3-month T-bill grew from $1 to $19. With the inflation-adjusted value of $1 being 12 today, you can see that you made a little bit of headway, but by and large over that period of time, you were standing still if you invested in that kind of risk-free asset. You were barely keeping pace with inflation. And in fact, on an after-tax basis, you probably didn't keep pace with inflation. The next line up, the blue line, that represents an investment in a 20-year Treasury bond, or sort of a constant maturity 20-year Treasury bond. Now, that represents at $93 a significant gain over the $19 we earned in T-bills, but you took a little more risk along the way. 20-year Treasury bonds are more volatile, sometimes significantly so, than 3-year T-bills. But you got 5 times as much, essentially, very nearly 5 times as much by investing in them. The next line up, the red line, that represents an investment in U.S. blue chip stocks. And in fact, that's the performance of the Standard & Poor's 500 stock index. At $1,800, you can see that we're talking about a vast increase in value. And in fact, the only reason it's as close as it is to the bond line is because I had to use a logarithmic scale where everything goes up by a factor of 10 as you move from one marker to the next in order to keep everything on the same page. Finally, the green line represents the performance of small company stocks in the U.S. over that period of time. And as you can see, small company stocks produced a return produced an ultimate value that's almost 5 times greater than the blue chip stocks. Now, what's interesting is that each of these in turn manifested more risk, more volatility, more uncertainty. And so the historical record would suggest that where there is more risk, where there is more uncertainty, the markets are going to do a pretty good job at pricing these assets to have higher returns. That certainly has been the experience since 1926. Now this scary looking thing is the S&P 500 from that prior chart. And what I did is I struck a horizontal line showing the average return over that period of time, which was above 10%. The red line represents the year-by-year returns. And as you can see, you had to take one heck of a roller coaster ride in order to get that nice double-digit return over the long run. And in fact, this range of uncertainty, if you were standing at one point in time, looking a year into the future and trying to anticipate what the return would be, based on historical precedent, the only reasonable answer you could give is that, well, the return is going to be something better than a 40% loss, but less than a 60% gain. Frankly, most people would not consider that to be a useful answer. Now let's look at another asset. This one is much more amenable to prediction. If you're standing at one point in time looking 1 year into the future, you're not going to have to suggest anywhere near as large a range of returns. And in fact, you can see the year-by-year returns tend to hover pretty close to the long-run average. Now, this represents the performance of a 5-year Treasury note. Here's something that's notable. This range of uncertainty was much smaller, but so was the return. The average return over that period of time was barely 5%. The way to think about this is that the red line drives the black line. The scarier the red line, the scarier the year-by-year returns, the more likely that that asset will be priced for a higher return over the long run. Let's look at it another way. Today's price, if you're looking at a stock, today's price has implicit in it some future price. And the difference between today's price and that future price represents the return that investors expect to earn. And you can see that in this particular illustration, we're assuming that tomorrow's price is going to be higher, and so that higher price is going to represent some implicit return compared to today's price. Now, of course, there's always some range of uncertainty about what's going to happen, what the future price is going to be. Now let's imagine that that range of uncertainty has increased. What is the market going to do? What are investors going to do? What do we know about investors? Investors are risk averse. Human beings are risk averse. When that range of uncertainty becomes greater, we perceive it as greater risk. And so we push the price down. The market pushes the price down through investors. Investors buying and selling will cause the price to rise and fall. That's in fact all markets do, is push prices around, trying to equate the current price with the future prospects. By pushing the price down, the market establishes a new return relationship. This is now a steeper line that connects today's price with tomorrow's price, and the fact that that line is steeper means the implicit rate of return is higher in recognition of that greater range of uncertainty that's emerged. And in fact, this is the mechanism by which value stocks are made, and I'm going to talk about those more. So let's talk about this notion of value stocks. A value stock is one that is trading at a low price in relation to either its earnings or its assets. And I want to talk to you about a study that was done a few years ago by some gentlemen named Lakonishok, Vishny, and Schliefer, in which they were looking at this notion of value stocks versus growth stocks, or value stocks versus what they called glamour stocks. And in order to pursue this question, they took all the stocks in the market. They had a huge database, and were able to take all the stocks in the market in a given year and rank them by how relatively expensive they were, from the ones that were very expensive, the glamour stocks, to the ones that were least expensive, the value stocks. And they then divided that ranking up into 10 equal number portfolios. I think at the time there were about 5,000 stocks trading, so these 10 portfolios had 500 stocks each in them. And what they did is they measured the performance of each of these 10 portfolios over the next 5 years. And they would take the next year, the data for the next year, when they would re-rank all the stocks, form 10 portfolios, and measure those for 5 years. So they accumulated a whole bunch of 5-year portfolios that they could use to draw some conclusions from. What they found is that the glamour stocks had the worst 5-year performance, while the growth stocks had the best 5-year performance. And each grouping in between followed sort of lined up perfectly along this dimension. Now, this finding has emerged in many different studies. What I liked about their approach is that they then flipped it around, and they asked, well, what was the performance of these stocks in the preceding 5 years preceding the time that we ranked them? And what they found is that the glamour stocks had the best performance. That's how they got to be glamour or growth stocks. And that the value stocks had the worst performance. That's how they got to be value stocks. So this is a case of the market pushing the prices down. And in pushing the prices down, it was requiring that those companies, that group of companies, to have a higher return. And in the aggregate, the market appears to have done a good job. Now this is this touches upon the question of diversification and its importance. One of the things that it's always important to remember is, to the degree that value stocks have higher returns, they do so because they are riskier, because they have higher perceived risk. And so because they're riskier, you cannot just buy 5 or 10 or 15 or even 50. You have to buy 500 or 5,000 in order to be adequately diversified. And in order to capture the fact that the market does a good job in the aggregate. It does a good job for that strata of the market as a whole, but it doesn't necessarily get it wrong with respect to each individual stock. So by buying that entire collection, by buying that entire strata of the market, if you will, you increase the probability that you're going to tap into that fundamental goodness that the market exhibits, that's fundamental ability to do a good job in the aggregate, setting prices in a way that their returns will be reflective of their risk. So let's begin to talk about what the implications are for how we approach designing and managing a portfolio. First of all, we look around us and we try and identify those assets, or those classes of assets, if you will, that for the risks taken have attractive returns. You know, it's possible to take risk without having a real expectation of return. You can pocket a big wad of bills and go to Las Vegas, and you may come back a winner, but it's not because there's a systematic return associated with trips to Las Vegas. Likewise, there are ways in which you can choose to invest in the markets that do not have a systematic return associated with them. So we want to look for those areas in the market where we think there's a consistent and systematic return to be had over the long run for the risks we take. We then explore how well these different potential building blocks combine and how well they play together, if you will, in a diversified portfolio. We look to choose efficient building blocks, and I'll explain in a minute what I mean by that. We'll assemble the portfolio, monitor, rebalance, and report, and then repeat. It's a cycling process. We can never stop. We have to keep coming back, monitoring our progress, measuring our progress, reporting it, rebalancing the portfolio. These are all the things that are necessary to keep a portfolio on track and to maximize our ability to both, I will say, to both sort of skirt along the edge of chaos, to manage that risk, and also to harvest as much return as is available. So I've already talked about some of those categories that we think are attractive additions to a portfolio. We think that small company stocks are a very important category to include. We think that value stocks are a very important category to include. And we think that it's very important to be a global investor, to be buying small company as well as large company, value stocks as well as broad swaths of the market all over the world. And of course, fixed income, which is to say bonds and bond-like investments, also have a very important role in the portfolio and also require that we be global investors. So it's possible to measure, ever since 1952, when a gentleman named Harry Markowitz first properly specified how to measure the risk and return of a portfolio of risky assets, for which he later, I think it was in 1990, earned the Nobel Prize in Economics. Since 1952, we've been able to, given a certain set of assumptions, we've been able to measure what a portfolio would look like based on different combinations of constituent assets, based on the different building blocks that we might put into that portfolio. So what we're always looking for are combinations that represent the highest return available for a given level of risk. Doesn't mean there's just one right portfolio, but it does imply that there's one right portfolio for a given level of risk. You don't want to choose a combination that falls below that so-called frontier, because it would suggest that for the same level of risk, there's some different combination available that would have a higher return if you go up, or alternatively, that for the same level of expected return, there's a different portfolio that would have less risk if you move to the left. So we always want to be on that frontier. We want to be efficient in how we combine these building blocks. And what we end up with is potentially a lot of very discrete building blocks along the lines of what I mentioned earlier. Large company stocks and small, value stocks and broad market, foreign and domestic, fixed income versus stocks versus equities. So we look for those combinations that are attractive, and then we bring them together. Now, in making these decisions, we will many times choose to hold an asset in much larger proportion than its share of the market as a whole. This particular chart shows us, with the blue bars, shows us the relative proportion of the market made up by different size categories. What you can see is that small company stocks represent less than 10% of the value of the market, whereas large company stocks, the largest 500 for example, represent over 70% of the value of the market. We're not neutral when it comes to how we allocate across size categories. Instead, we will consciously dial up our exposure to small company stocks relative to large company stocks. So we dial up our exposure to small company stocks relative to its natural share of the market. We dial down our exposure to large company stocks relative to its share of the market. And the result is a portfolio that we believe will have higher returns because of the higher proportion of high returning small caps or small company stocks. And it will also be a portfolio that potentially gets some diversification benefit, because large and small company stocks don't always move in perfect lockstep with each other. And in fact, sometimes they go in exactly the opposite direction. So by having these in more or less equal proportion, what happens is there will be times when large company stocks do poorly and small company stocks do well, and we will have a large enough allocation that that can actually benefit the portfolio. And of course, the opposite is also true. We're never going to bet everything on one size category, just as we won't bet everything on any one country or any one region. Now, selecting efficient building blocks. Once we've designed this portfolio, once we've taken our, you might say, architectural approach, we've actually designed a blueprint for the portfolio, we want to choose building materials that are as perfect a match to our design as possible. You know, if you have a blueprint for a home and you begin to build it, you want to make sure that you put the most perfect window you can in the space indicated for a window, and likewise for a door. One of the things that you find very often when you look at fund investments, you know, retail mutual funds often are subject to a thing called style drift, where they drift away from their stated investment objective. And a small company fund, one day you wake up another day and it becomes a mid-cap fund. A value fund, you wake up one day, it's become a growth fund. It would be a little bit like putting that perfect Pella window into your home and then turning around and finding that it had morphed into a door. So we look for building blocks that will always give us precise exposure to that segment of the market that we've identified as attractive, that has the lowest possible fees and expenses, and that, where appropriate, will be tax efficient. Some of those efficient building blocks include some open-ended index funds from Vanguard, some exchange-traded funds, often referred to as ETFs. These are just index funds that trade on the stock exchange. We use a number of portfolios from a company called Dimensional Fund Advisors, and other, where appropriate, other institutional class shares. Dimensional Fund Advisors, I might mention, was founded by David Booth and Rex Sinkfeld back in 1982. And they had both come out of the University of Chicago and decided that we had learned a lot through formal academic research about how markets worked, but few, if any, were actually putting those insights to work. So they set out to be a research-based company, to be a company that was going to harness the best of the academic research and the best of the formal insights that had been achieved into how markets work and build investment strategies around those. And so they do a beautiful job of what I call slicing and dicing the market and giving us exposure, for example, to small company stocks, microcap stocks, and value stocks. So we find them to be very useful building blocks for the kinds of portfolios we know we want to build. Now, once you've assembled that portfolio, no matter how efficient your building blocks, you're not done, because portfolios will tend to drift. Some of the asset classes, some of those building blocks will grow faster than others. Will end up they'll run ahead of their target within the portfolio. That window that's supposed to occupy a certain amount of space gets too big. It becomes a sliding glass door, and you don't want a sliding glass door there, so you need to shrink it back to its original proportions. And we do that through rebalancing. Rebalancing is a discipline whereby those things that have gotten ahead of their target, we shave them back to their target. Those things that have fallen below their target, we top them up. You can think of it a little like this. Imagine that black horizontal line in the middle is the target for a particular asset class. Well, it will tend to find its way above or below depending on what's going on in the markets and the economy. When it crosses a predetermined threshold, such as the one I've indicated with a red line above and below that target, that's going to trigger rebalancing, and we're going to want to shave it back. Now, in the abstract, you could think of this in terms of an asset becoming relatively expensive and having us sell some of it, and other assets becoming relatively cheap and having us buy more, so that in a very real sense, we're buying cheap, we're buying low and selling high, which we all know is what you want to do. Now, what makes this a discipline is the fact that in actual practice, the thing you're selling is something that's been making you very happy recently, and the thing you're buying is something that's made you relatively sad recently. And it becomes very hard to pull the trigger on that unless you approach it in a very disciplined and systematic way. Finally, allow me to close with a few simple concepts. First of all, markets work. All the evidence points to markets doing a good job of equating risk and return, of setting prices today that take into account the uncertainty of future prices. Now, it's true that they can sometimes look chaotic because the world is chaotic, because things change and markets have to constantly change in reaction to that. But that is markets actually doing their job and doing it well. Market timing doesn't work. There's no evidence for it. It would require the kind of perfect foresight that no human being possesses. And finally, there is a way to manage risk and harness the available returns, and that is through a disciplined approach to design, asset allocation, diversification, and rebalancing in a broadly diversified global portfolio. I hope you've enjoyed the few minutes we spent together. There's much more to be found on our website, not just on the topic of investments and the economy, but on the topic of financial planning and how your investment approach should be embedded in that much larger context of your comprehensive financial plan. So I hope you'll visit us at www.yebu.com, and please contact us by email or telephone if you have questions.